Hey everyone, my name's Andy. Today we've got Shubham with us to talk about oil. Not really too much in natural gas, right, Shubham? A little bit
Yeah, I'd say
natural gas.
oil is top of mind these days. Natural gas still maybe a few months out for the thesis to play out.
So thanks for coming on, Shubham. Really appreciate it. Glad that you could come back on the channel. So thanks for taking the time to come back on. So big picture view, what's going on in the energy space, more particular oil space? What are you looking at? What are some important news items or things that people should know in the short term here?
Yeah, 100%. I think there's been some miscommunication, I would say, over the last 6 months as to what really were the important factors to track. There was too much emphasis being put on certain things within the oil market, and we have now sort of cleared the clouds. And we're saying, okay, what's important? You have the Saudi Arabian exports, which are hanging in below at the levels that exactly what they said they would get them down to. We have Russian exports hanging down exactly the levels that they said they would get to. Very strong OPEC plus cohesiveness at this point, despite some of the Iranian barrels ending up on the market, despite Libya being kind of full max capacity, despite Iraq exporting at max capacity, at least within the quotas, and some of the other countries too adding barrels as well, such as Brazil. So really good resolve on OPEC plus to manage the supply portion of the market, and we're seeing demand just continue to run up. So despite all the narrative that we're in this dying, I think we're seeing demand numbers that continue to impress, with a large portion, some portion of the world that's still yet to reopen. So we're still seeing some lag on the Chinese international jet fuel. We're still seeing some lag on the Australian jet fuel. We're still seeing some lag on the overall Asian market, Korea, Japan, Singapore, Indonesia, as they reopen. If some portion of demand is still missing from Russia, obviously, given the slowdown and the sanctions being put on the country. So despite all of that, we're still running well above pre-COVID demand, and OPEC Plus just came out with their MOMR report, guiding towards a 2.25 million barrel per day increase in demand next year, 2024 over 2023. So 2.25, that's over 2% growth rate year over year. So we're not only growing demand at our typical 1.25% clip, we are growing it to resurge back to that pre-COVID trend where that would have headed at this point in time. So watch for that to play a factor in 2024, and then as well as 2025 going forward. In the meantime, you're seeing the U.S. production complex has not responded in the same way. So the rig counts are still subdued, the frac fleets are still subdued, and yes, there's still some production growth that's coming in from the smaller basins. There's still some production growth coming in from the Permian itself, with the delayed impact of continued DUCs, and also at this point, we're seeing some indication that wells were fracked about 6 to 9 months ago, which are now being brought online. So there's a TIL, turn in line delay, that is being exploited by some of these producers. They chose to frack the wells and then not bring them on until higher prices, and now they brought a surge of that online. Watch for this to play out in the next couple of months, what the decline rates are on that production, and how much more there is to go on that side of things. So that's demand and supply. We're seeing U.S. commercial crude obviously down about 40 million barrels in the last 6 weeks. Actually, when you add this week, it's down about 37 million barrels, let's say, in the last 7 weeks. So still a very, very healthy draw rate. And really, the area to watch for is Cushing, where we're now well below where we were when the SPR release was ongoing. So some theories that all the SPR release did was really end up in Cushing, or displace barrels that would have left Cushing, got stored in there. It gave the paper traders some excuse to go and sell a lot of contracts because they had that physical barrel to sell in Cushing. Now that that's being drawn down, you're seeing that pressure on the paper market ratchet up, along with, of course, there's no physical barrel there in Cushing. So definitely one that's not just important now, but to watch for any foreseeable SPR release in the future. So those are really the major trends to watch. The oil on water is down about 100 million barrels in the last 3 months. So really, that's where the Saudi Arabia and OPEC targeted the first cuts. And as they drained that excess, they now got into the onshore side, where we're seeing some really, really nice draws. So looking forward to kind of how things go. One of the points that I'll mention right off the bat is that it doesn't look like China is willing to release their inventories as long as OPEC has continued their cuts. So there's some polarizing viewpoints on this. So far, it looks like they've had record crude import numbers in August and sustaining that momentum throughout September. So looking like that bullet is not yet ready to be fired until possibly much higher prices or until OPEC Plus adds their barrels back on the market.
So we've got inventory. I've noticed that too. We've drawn the inventories down. All the other inventories, SPR, stuff like that, seem to have drawn down quite a bit. We're at breaking $90 a barrel here with inventory as low as where it is. Last time inventory was at this level, it was at $120, right? With a bunch of SPR barrels and everything behind it. Do you think the market is mispricing oil right now?
Yes, so a couple of factors I would say. One being, of course, we're at much higher interest rates. So people are unwilling to take that bullish bet when the margin requirements have changed, when that dollar to borrow that you're paying 5.5% more, which in some cases could be double or maybe 4x what you were paying to borrow that same dollar this time last year. Maybe not quite, but within that same range about 18 months ago. So are they willing to go and take that bet? Possibly, possibly not. The other factor is I think there's a lot of geopolitical risk premium that got priced in last year, saying, hey, Russia's going to lose 1 to 3 to in some cases 5 million barrels per day over a 6 to 12 month period, which I think is no longer priced in. Is geopolitical risk in general underpriced in the oil markets? Yes, but the market is just not willing to go and do that. So we need the two structural changes to be believed by the world in order for them to switch their mindset from energy abundance to energy scarcity. The first one obviously being that OPEC Plus is back in control. They're willing to go and cut those barrels to the point required. And the second one is that US shale cannot come and add that million barrels per day growth. If you tap it on the shoulder and say, hey, oil is $90 a barrel, are you going to grow 1 million barrels? And the answer right now is really pointing towards no. So there's been some significant further well productivity degradation in 2023. There was some thesis that, hey, 2022 producers just drilled the tier 2, tier 3 wells, which is why you were seeing productivity degradation. Well, 2023 has proven that thesis to be false. We're now seeing continued productivity degradation, which is pointing towards an overall basin problem, a overall geology and reservoir production operations problem that's going to plague this as we continue to go on. So part of that is driving some of the reduced activity by some of the Permian players that have inventory. They're seeing this internal issue creep up as the months and the years go by. So is oil underpriced? I think you're asking me. I'm always going to say it's underpriced because I'm looking at what's coming into the future. But at the same time, people are unwilling to make that bet. They'd rather say, you know what, we'll just wait. When it gets there, then we'll push it up if need be. What's going to drive when that exactly happens is how much inventory further drains and just overall geopolitical risk in the market. If there's another incident of some sort that requires the market to put its head up and say, yeah, we need to find those barrels right now. And on top of all of that, I think you're seeing a over exaggeration of the spare capacity that's on the market. So we can argue all we want about the number of barrels that are on the market. It really doesn't matter if the person holding that card is not willing to play it. So why do you keep saying there's 5 million barrels of spare capacity? There's no case in which all of those would end up on the market right away. or where they're willing to release those to depress the oil price. So it's more than a raw barrel counting exercise. There's a bit of personalities and understanding the countries involved part of it, which I think, again, the world is unwilling to accept quite right now. But as time goes on, I think they will have to accept it. Their hand will be twisted, and they will be forced to accept it. And that's essentially where we find the next catalyst here to continue rising.
So speaking of demand, and you've got the supply side, compared to other setups in history as you follow the oil market, would you say that demand is more robust today and supply is more fragile, given the current markets versus other markets in history? Kind of what's your opinions there?
Yeah, great question. So I think the demand picture is relatively on trend. So people have always counted out demand. They've always tried to call peak oil demand. They've always said we're going to substitute this or do this, and it's going to reduce oil demand. Yeah, there's some things that are reducing oil demand, as in petroleum oil. But at the same time, we see that worldwide petroleum consumption continues to rise. So there is a sort of dislocation in the way people view oil, and the way that especially the emerging markets view oil, and the population densities that are present in those areas, versus what the actual power you can produce out of that each barrel of oil is. So if you can replace 50 workers with one tractor, maybe you're saving $400, $500, $600, $700 an hour, but yet the fuel cost for you is $100 per hour. If that doubles, well, you're still ahead because you've already paid for that tractor, or it still makes sense to go and replace them with that automation. So I think oil is still relatively cheap, so that demand number just continues to go up because people are realizing how cheap it is compared to sort of its benefits, its raw benefits. The other point on supply, I think supply is also very robust, similar to last cycles. So we're seeing a lot of surge capacity come online because oil was in the dumps for 7 to 8 years. So there were some barrels that just got left stranded. And then as prices rose, those barrels ended up popping out of nowhere. But essentially, they were just wells that were not economic to bring back on in a $50, $60, $70 oil environment. So those barrels have come back. We've also seen some big projects come online in the last few years, which were sanctioned in 2012 to 2014. So the money was spent 10 years ago, and those just came online. Some would be the Johan Sverdrup field, the Kashagan field in Kazakhstan. They have started to come online later on versus when the money was spent. So all that said, what's different? The difference is the supply response. So in previous cycles, when you saw oil hit $90, $100 a barrel, you would see companies go in and just spend money. They would go and spend 100% of cash flow, 150% of cash flow. They'd be running deficits in order to fund production growth, in order to fund exploration and acquisitions, and some of them still paying some big dividends on top of that. This cycle, they don't want to do any of that. They don't care what the price of oil is. They're going to only spend 30 to 50% of their cash flow. The rest of the cash flow is going to pay off debt, to go and buy back shares, acquisitions still, and then also much bigger dividends than they used to pay, and more prevalent across the sector. So what does that lead to happening is, as that demand stays robust, as your base supply stays robust, you're seeing supply not respond to the incremental growth in demand. So as the cycle goes on, it just gets stronger and stronger and stronger. And when you do put that dollar into the ground and say, okay, fine, oil is this price, I'm going to go and sanction this $1 billion project, well, it's still going to take you 2 to 3 to 5 years for that barrel to come online. So in the meantime, in 3 years, oil demand could be another 3 to 4 to 5 million barrels above what it is right now. Where are you going to find that oil? So that, to me, is the reason why this is a higher for longer cycle. That, to me, is the reason why it really sets up nicely for a structural bull thesis, because you are not seeing that response. And on top of all of this, you have the fact that US shale is teetering on this edge where you could end up losing a lot of barrels here, especially when you try and forecast this over a 2 to 3 year period into the future, and model in the continued productivity degradation. There's some questions that are going to be answered month by month by month. It's just too early to go and make definitive conclusions as to how this is going to play out. But when you look at the cards that are on the table, when you look at the cards that are in your hand, you say, okay, I've got pretty good statistics here as to the value that I can get. And underlying this entire macro thesis is the fact that you can buy companies today in the small to mid cap space at sub 3 times cash flow, whereas previous cycles you're buying them at 6, 7, 8, 9 times cash flow, some as far as 15 times cash flow. Well, the risk reward proposition is just not the same in that case. So yeah, that's how I see this cycle deferring. And I guess I'll make that point right now is the perception of risk is very, very important to keep your head wrapped around. When you see companies in the sector that are just smaller versions of their bigger brothers, but they're trading at a third the multiple, keep in mind, what are you defining as risk? Because if you just look at a small company and say it's risky, that's the absolute wrong way to look at it. You got to look at what valuation am I paying to get that same sort of business. If you're paying 3 times the valuation to get just a bigger business, which has the same debt profile, which has the same or very similar access to capital, which has very similar properties, which has very similar inventory life, well, you're the one actually taking on risk, because in a drawdown, the thing that's trading at 2.5 times cash flow, how low could it go if they're buying back shares and paying a big dividend? Whereas you're buying something at 7 times cash flow or 9 times cash flow, it still could drop a fair bit in a drawdown in oil prices. So the perception of risk, I think, is very, very misconstrued today. People are trusting blue chips that are just way overpriced compared to their small to mid cap peers. And hey, value dislocations is what I'm here for. So we'll try and take advantage of these as much as possible from here on out.
Yeah, if we were to take a big picture view of the world and we were to look at the oil production of the world, and as oil prices go up, what are we going to see turn on? Like, for instance, generally you go from low cost producers, then you start working your way up into higher and higher cost producers. As the oil price goes on, how can we monitor where we're at in this cycle? Do the offshores turn on next, which they're kind of doing? Does Canada turn on and they just full on start producing? Like, what are the steps in this bull market that we'll probably see over time? Because as price goes up, we'll say, okay, this is what's going to turn on next. This is what you'll see. Inventories will rise, or what are we supposed to look at, and how are we supposed to monitor the development of this bull market in oil?
Sure, yeah. So if I understand the question, I think the first barrels you will see are going to be from OPEC plus. So they are gonna, as they see this ramp up, they are looking for a specific inventory number. So I don't think they're specifically targeting a price. They are targeting a price that they want to be at the floor. They are targeting a price that they likely don't want to exceed. But those things are very, very difficult to maintain within that range at all times. So what are they targeting? They're targeting the spare bullets of the world to be fired. So they want the US commercial crude lower. They want the oil on water lower. They want any country that wants to release onshore inventories like Iran, go for it. They want any country with a spare floating storage, release it. We don't want these bullets in the market. They want anything that's going to add low cost, kind of free barrels to be added onto the market. So what are we talking about? We're talking about US conventional. We're talking about any sort of tiebacks, cheap tiebacks. We're talking about Canadian fields that can be brought back. There's some oil sands fields that have been shuttered in for 5 to 7 years that are slowly ramping back up. We've got some other capacity offshore that can be brought back. Older, tired fields. that are slowly adding barrels. So they really are targeting all these barrels to end up on the market. Well, 2022, we saw a lot of these barrels end up on the market, which is why supply all of a sudden went way higher than some of us oil bulls were predicting. So fine. We also see slow growth in the Iranian barrels. We see Libyan barrels stay at that 1.2 million and possibly rise a bit. We see some growth out of Argentina. So they really want these low-hanging barrels to be brought onto the market. Now that that's well underway, your next barrel is going to have to be from OPEC plus. So as that demand continues to rise, they have to, in some way or another, unwind on those cuts. How exactly they do that is unknown. Does the Saudi Arabian lollipop cut get brought back first, or are they willing to take the brunt of that and say, okay, we'll unwind the OPEC plus voluntary cuts first, and then come back to our lollipop cut so that we have control at the end of the day as to what happens. So really watch for those barrels. As far as offshore, Brazil is the one to watch. They are going to be the ones that add significant barrels. They also have a decline rate, obviously, on their existing production that still is there, and they have to make up for it. So when they go out and say we're going to add 2 million barrels of FPSO by 2028, keep in mind that 2 million has to make up for the existing decline plus the new growth. So that's the one major area to watch. Guyana is relatively really well projected and forecasted. We know when the FPSOs are coming online. We know when they get FID'd and sanctioned. There's about a 250,000-ish barrel per day growth till 2027. So just put that in the model and plug it in. Looks like Suriname might be FID'd sometime next year, where we'll see a 200,000 barrel FPSO by 2028. So the one thing I like about deep water offshore, you get really good clarity because you can't just go and tie back a bunch of wells. You have to produce your own new FPSO, which has really good clarity when it's built, when it's on its way, how the wells are being drilled, and when it's tied in and ready to produce. So all that information is very, very transparent. So those are kind of the two areas that I would watch for. I would still keep an eye on US oil production. The US always seems to find a way, whether it's tier 3 acreage, whether it's some of their older basins, whether it is some new drilling that happens in pre-existing basins, whether it's growth out of areas where we don't expect. I just saw a news release a couple of days ago that they are retargeting some conventional oil fields and looking at enhanced oil recoveries and CO2 floods. So the American system is just so economic, so efficient and capitalistic that they do ramp up to some extent. Now, the question really is, can it make up for the impending shale declines or the lack of growth that shale can produce? So it's all a petri dish that has to be taken into account, all the factors coming into it. And then really it's Canada. At the end of all of that, you have the Canadian oil sands. So within what's left to add 2-3 million barrels per day, you have the Canadian oil sands, you have Iraqi onshore, you have some Iranian onshore, you have of course the Venezuelan possible resurgence, and then you have the Middle East offshore. So whatever Saudi Arabia is doing in their offshore fields as well. So those really are your main factors that can add multi-million barrels per day. Anything else offshore, we're talking about Namibia, Nigeria, we talk about Angola, North Sea, the UK and Norway, some Russian barrels possibly. They really can't grow to that extent where they're going to affect the market as the decade continues. So of course we could have more successes in any of these countries and add those barrels, but right now I think really the cycle is going to start to really find its stability or its peak when you see some new Canadian onshore oil sands get sanctioned, when you see some major projects, like we're talking 250,000 barrels per day or 100,000 barrels per day, and many of them that start to get sanctioned, that's your warning bullet that, hey, watch this market very closely, watch the supply that's getting added over the next couple of years, and then watch as those projects start to come online at some point in the future. That's, I think, how the cycle is going to go. In the meantime, you're going to get production adds from various countries. You're also going to get production declines from various countries. They all mishmash together to really not really be meaningful. I think people are putting too much emphasis on countries like Argentina. They're putting too much emphasis on Canadian growth right now. They're putting too much emphasis on Guyana and Suriname. These countries are just not enough production for somebody to really watch for at this point in time. Like, put it into the model, but don't expect Guyana to suddenly add 500,000 or 1 million barrels a year. It's just not going to happen. That's not the way the FPSO and deepwater offshore work. So yeah, and then Brazil, Petrobras has on their quarterly reports, they show you exactly which FPSO they have, when it's coming online, how many barrels it's going to produce, and where they are on the status. All the information is there for you in one page. You don't have to do any work to keep an eye out on all of that. So I like that way because I have a few things I can track and have a really good idea of where we're going to go.
Yeah. So I know OPEC's, I mean, we've alluded to this, they're kind of controlling the market to some extent here. Can they lose control of the market? Could they get this thing where they're not producing, demand starts kicking up, and they're like, oh crap, turn it on quick, turn it on, and they can't slow down the price movement? Is there something like that that could potentially happen where they lose control of the market to the upside? They get people too bullish?
Yeah, I think the bulls are definitely going to like this question. So it is a definite possibility. So can it happen tomorrow? Likely not. You raise a really, really interesting point, because OPEC Plus always gets put as a villain. Hey, they're trying to maximize their own money that they're making per barrel at the expense of the consumer. Okay, sure. What they're also trying to do is raise the price enough such that new investment comes in, so you don't have this runaway train problem that you described. Once that runaway train happens, you're going to hit the demand destruction level. That's it. Whatever that level is, where people are unwilling to spend on petroleum, you're going to hit that level. We have traditionally never hit that level because we've never hit that producing the last barrel of excess capacity in the world. We have never got there. What would be the factors how it would happen? So I think there's a very, very clear line of sight to how this could happen. One, the most obvious way is if oil demand, let's say, grows the 2.25 million barrels per day next year. And let's say 2024, we start seeing lowering of interest rates. We start seeing some stimulus back in the market. 2025, we again grow 2+ million barrels per day. We see incredible growth out of China and India as they transition to a consumer-based economy. So China itself is more of there's so much savings in that country. There's so much money spent on property and manufacturing. As they transition to a consumer-based economy, like what the US is, you see exceptional demand growth. 2025, we see OPEC run through their spare capacity. We see OPEC unable to add new barrels because their projects are not ready till 2026, 2027. And in the meantime, if we see million barrel shale declines because they completely overcounted inventory. Now, this is going to require a bit of imagination because we don't know what the end game of shale is. Everybody can go here and run any model they want and say, oh, it's going to do this and do that. But the reality is, if we start drilling into other zones, if we start drilling into the fringe edges of the acreage, if we start drilling into tier 3 wells or the non-core areas, and you end up getting a significant drop-off in well productivity, if you start getting an incredible amount of frac hits and within zone, intra-zone frac hits, if you get parent-child well interference, that accelerates, you could see the decline rates that are going to push the market into that sort of runaway price action. So I would say it's not near term. It would take a lot of factors to really play out in that manner. But I also think there is a very clear line of sight to how this happens, given the world's decline rate has gone higher. And all of this, what I just said, could be accelerated if there's a major conflict somewhere. So if you see some major conflict in Iran where they lose 2 million barrels per day, if you see a major conflict in Libya where the 1.2 goes offline, if you see a major conflict in Russia, another one which results in major loss, those could accelerate how soon we get there. And that's really at the crux of this bull thesis, is people are not willing to invest. They just are unwilling to put that money into the ground. You can say whatever reason there is for it, but it's really a combination of reasons. It's higher cost of capital. It's the shareholders' need to get money back. It's the fact that the geology of the world is just degrading. It's the fact that deep water offshore, you can't be a small to mid cap player and you're out drilling deep water offshore wells. It just doesn't really work. So only a certain amount of companies now have that capex in their hands. There's many factors that are adding together in that, but yeah, I do think OPEC Plus needs to be very careful, both in the near term, in the sense that they need to add those barrels back when the world needs those barrels, and also in the structural bull cycle term, in the sense that if enough investment doesn't come in at $90 to $100 oil, to $110 oil, well, everything has a lag effect. So the world might suffer for a couple of years on the consumer end of things while we get there, which I think is a very unfortunate way to look at it. But also, that's exactly what 7 years of 0% interest rates and shale growth on steroids has sort of led us to, in this sense. So yeah, one comment I guess I will make is that don't expect equities to reflect a $150 or $200 per barrel oil price. They're not going to reflect that, because the world is not going to believe that we're there to stay, and we may not stay there long enough, because you would drive the world into a very, very tough economic situation at those sorts of prices if we get this runaway train sort of narrative. So it's going to become very difficult to decide when to sell in that sort of environment. So we want slow, steady growth. I'm not saying I control the oil markets and I get what I want, but as an oil investor, what drives higher multiples is stability, not always price volatility and huge ramp ups in short periods of time.
Where in the world is the highest cost producers? Where are they located? And when we see those guys turn on, we know that we're getting towards the end of the bull market, or not the end of the bull market, but we're getting towards the end of our supply capacity. Because we say, okay, these guys turn on, they're also going to be the ones that go ballistic, because now they're able to make some money. So is that up in Canada? Is that your oil sands, or is that the highest cost producers in the world?
Yeah, so I would say the highest cost producer is not necessarily the one that's going to be where the supply cycle goes, or when we know it's ending, because I think the way we need to look at this is, what is the highest dollar producer? Meaning, if we want to drill offshore somewhere, or if you want to drill deep water offshore, or if we want to produce the Canadian oil sands, you can't just put a $50 million project in and say, I'm gonna go and produce the oil sands. You got to spend multi-billions of dollars up front. After that, you have a low cost of supply. So you spend all this money up front, and then after you have all your facilities, your wells, your pads, your steam generation, etc. online, now you have a pretty low cost of production. So it's not necessarily the highest cost producer, it's what has the highest upfront capex to get those barrels out. And I think you hit the nail right on the head. You've got the Canadian oil sands and you've got deep water offshore. Those are the two that, when projects there start to ramp up, it's telling you that the market is willing to take a risk that this barrel is not going to be produced for at least 3 to 5 years, but we're going to take a bet on this such that we think oil price is still going to be high in 3 to 5 years. So that's the way that I look at it. I think the highest cost producers are already in the market today. They're already producing at today's price. We talk about some of the higher cost enhanced oil recovery projects. We talk about some of the very, very high water cut fields. We can talk about some of the very remote fields in northern Canada, or even in the US for that matter. We can talk about some of the fields in the jungles of South America. But those are all online. Everything's being produced as we speak. And going forward, I don't see any high cost producer that can just increase production by a lot, such that it matters to the world supply. There are high cost producers that can double or triple their production within a 2-year period. But what are they adding? 5,000 barrels, 10,000 barrels? It's just not big enough on a global supply scale. But the capex is really, really hard to come by. Nobody today wants to spend $4 billion on an oil sands project betting 3 to 5 years out. And part of the reason for that is because of how long the lower for longer cycle went on for. So people put money in 2012. They put money into Meg Energy. They put money into Cenovus. They put money into Suncor. And what happened? Those projects never made money, and they just now are breaking even on getting their capex back. Well, that's 11 to 12 years. In the meantime, they could have made hundreds of percentage on tech stocks or in real estate or any of these easy passive investments, yet they took a risk and they were never rewarded for that risk. So why would they come back and put that dollar back in the ground? Well, they have to believe in an extended long cycle. And an extended long cycle, it takes a lot for people to believe in an extended long cycle in oil. I feel like people are just always just negative on this industry. They'll put money in and always be scared to lose it. Whereas they'll buy something else, or they'll leverage 20x on a house, and it's just like, oh, this is fine. But buying an oil stock at 3 times cash flow is all of a sudden pain inducing. So I still think we're there in this markets. It'll take a while for that to normalize, and you and I will be here for that ride as that roller coaster goes up this up the track.
Here's another question. I'm just going to throw you. I know that you're a bull. I get it. So am I. What do we understand that the bears are missing? Like, what are they messing up here? Just curious to see what your opinions are on that.
Yeah, I honestly think all of the above. So it's not that one singular thing, but was missed by one person. I think on the overall, there's a lot of things missed. We as oil bulls missed a few things as well with increased supply. But really, at the end of the day, it's not about what you missed. It's about how much money you made and how much money you're gonna make in the cycle. That's really all in my mind that's important. So what did the bears miss? Well, going into 2022, they were bearish. They were bearish at $80 oil, $85 oil. They missed the entire run up to 120 and the re-rating of the stocks. Some Canadian small to mid caps were up 200% from December to June 9th. Okay, they missed that entirely. And then they either shorted too early or they never shorted at all because they had no money left by the time we got to the top in June. So they made no money on the way down. And then there was very little opportunity to make money from like November of last year to June of this year. Yeah, you could trade in and out a little bit, but really neither the bulls made money nor the bears made money. Nobody made money in that time frame, other than maybe some specific small caps or junior growth cos. And then from June onwards to now, the run we've had, they again made no money. So, and in fact, some of them got blown out because they were shorting at $80 oil once we got there about a month ago. So that's what was got wrong and what the bulls got right. Now, on a structural thesis, what was wrong? I think the lack of belief in OPEC was the first critical mistake, right? Let's be honest. If OPEC had not cut the 2-ish million barrels that they have, we would not be here. So we would not be in this position talking about this with such confidence today. So the one thing that was missed was the OPEC plus cohesion, the OPEC plus resolve, and how strong they would come out of that. People in March, April, May were cracking jokes that, hey, what happened to your $90 put? What happened to your $80 put? We're here and MBS is this and that and Putin's crazy, blah, blah, blah. Like, okay, well, what was happening underneath all of this. These people are not robots. They're humans. They act like a chess player. They will make moves that you will only see coming multiple months down the road. So that was missed in all the back patting and the chest thumping. They missed that OPEC Plus was doing things in the background to increase that price per barrel of oil, to go and support their own economies, to go and support new investments into the sector. And I think many people refuse to believe this because they weren't in the oil markets in 2008 to 2012 to 2013 when OPEC was in control. I myself was not in the markets, given that I started investing in September 2013. But the one benefit that I had was going through a petroleum engineering program. I saw that energy scarcity mindset. It was so prevalent. It was like, oh my God, we're going to run out of oil. We're going to have no oil left. We need to find more sources. There was talk about going into methane hydrates, like these pools of methane off the coast of every continent, and going to produce this underwater bubbles, for lack of a better word. We have no money. We're not going to do this. We won't be able to drive gasoline in 10 years. Like, it was just absolutely insanity that was going on at that time frame. So my thought process was that, okay, there has to be something behind this. And it was OPEC plus control, along with, of course, that demand continued to just ramp despite prices being higher after the 2008 crisis. Well, that's exactly where we are now. Demand continues to ramp, and yet we don't have the supply, but people are not worried yet because they still think, why are you creating panic? At $100 oil, shale can add 1 million barrels per day for the next 5 years, every single year. That's their thesis. Well, there's an engineering and geology reason why that's not the case. There's a capital markets reason why that's not the case. There is a consolidation, a basin consolidation reason why that's not the case. So missing the underlying variables, looking at just the top level data, is, I think, has got people in trouble, and it's going to continue to get people in trouble because they're missing the internal decline rates that every single oil and gas well and basin has. So I think those are the main reasons. Those are at the base of the bull thesis. Those are what's going to drive increased valuation. Those are what's going to drive increased appetite and the bullish mindset. So those are the things that they got wrong. Like, there's not really any other reason. Yes, there's minority reasons, like the fact that a lot of people have been counting out China. Why? Well, one core reason: they're trying to correlate property and manufacturing PMIs to oil demand. Those two things are not the same. You can have lower growth in the property sector. Remember, a PMI below 50 doesn't mean that the whole sector has collapsed. It just means that the sector is shrinking slightly. So you could have a PMI under 50 in manufacturing, you could have property sales down year over year, and you could still have oil demand growth in a country that's moving to the middle class, in a country that's buying 25 million vehicles a year. So it's just raw kind of looking at the variable sort of analysis. And a country that's increasing its flights by 500, 1,000 a month. So I think that part was mistaken. And really, those are all the things that matter today. Those are the exact factors that matter today, along with, of course, the demand that's coming out of the emerging markets. I think that is also missed, and it's going to be missed as time goes on, is that the emerging markets don't care. They just don't care for the price of oil. They want oil, they're going to get oil, and they're going to consume oil. And the large majority of people in these countries that are consuming oil is not your average guy making $2 a day. It's the upper middle class. It's the ultra rich. Do they care if oil is $80 a barrel or 110? No. For them, it doesn't matter. It's a matter of status. It's a matter of convenience. It's a matter of just raw utility, and they will continue to consume regardless of where price goes. So the demand destruction impact is a lot more prevalent on the edges in the North American and European markets compared to the emerging markets, who just don't care. For them, it's just such a blessing to have oil that they love consuming it. And so does America, for that matter.
So where we're at today, given where we're at, we've got $90 barrel oil. You mentioned earlier that some of the larger cap players, they're a little overpriced in terms of price per cash flow. We've got some smaller cap players. They're cheaper, definitely. So how would an investor play this? And if you could share some names with everyone that you really like, where should people be focusing? What are some names that might be a conservative investor would maybe look into? And what are some names that maybe a ultra aggressive investor would look at? And why would you look at these particular companies?
Yes, I'm glad you brought this up because I have very strong views on this specific question. So let me sort of throw this example back at you again. So if you're a conservative investor, you're saying, hey, I want big companies, I want safe companies, I don't want to take on units of risk. I just don't. And you look at a company like CNRL, okay, the blue chip of the sector, making million BOEs, maybe over a million BOEs, diversified oil and gas. It has somewhere in the range of 10 to 15% debt as a factor of its EV, enterprise value. Relatively safe. It's paying a 5 to 6% dividend. They've got good growth assets. They've got good current assets. They don't really have any geographical risk where they're in jurisdictions that are unstable. Okay, great. It trades at 9 times cash flow. Now you have a company that is smaller. It is 50,000 BOEs per day, the same gas to oil ratio, the same level of debt on the enterprise value. We have, which is very low to begin with, 10 to 12% of your EV being debt is very low in the oil sector. You've got that company also paying a 6% dividend. You've also got no geographical risk in that company. You've got good management that have proven themselves out as value creators, and you have them not doing anything that's crazy. The assets are normal, the same way CNRL has assets. Okay, where is the risk? So the smaller company is trading at 2.7 times cash flow. The risk to me is in taking on a much higher valuation for two reasons. One is that you're not gonna re-rate from that point. Like you're already trading much above your peers. Your upside case is capped, and you're taking on a lot of downside risk. If you're saying you're conservative because you think that if price falls to $50 a barrel, you want to be safe. Okay, I get it. Well, which company is going to fall more? Is it the one that's at 2.7 times cash flow, paying a 6% dividend and buying back stock? Or is it the one that's at 9 times cash flow, paying a 6% dividend and buying back stock? Which one is going to come down more in a drawdown in oil? And I realize the cash flow metrics change depending on the internal cost of the producer, depending on where WTI prices is. Yes, the internal cash flows will change, but at the same time, which one has more downside risk? And that's why I think the bigger companies are overvalued. You're not getting the upside participation, and yet you're taking on a much higher valuation. If the valuation gap was 1 or 2 multiples, it'd be fine. But for it to be more than 3x, something doesn't really make sense. So where should the investor look at? If you're a investor that understands oil, you think that we are set up for, let's just say $80+ oil. You think there's the off chance that we hit 100+ oil. Great, you should be in this industry. If you think that we're going to linger around at $72, $75 oil, or that we have a chance to go down to $50 oil, there's no stock I can recommend that I would feel safe telling you that, hey, you should buy this. You should just not be in the sector. Until you have that bullish thesis, which comes in the oil industry every 5 to 7 years, you just shouldn't be in the sector. You're not going to make money. You're going to waste your time. You're going to be stressed out. You're going to be panic attacks from the price volatility. You're not going to have fun. Now, if you do believe in that higher price environment, you don't need to believe that oil is going to $150. You just need to believe 80+ with the off chance, some probability of 100+. If you believe that, I think the Canadian small to mid caps are some of the best places to be. So variety of reasons. We have better geology right now in Canada, better untapped geology compared to the US. you have lower decline rates, you have higher reserve values, so you have more inventory depth and quality. We have some of the technologies have not been implemented in Canada that have been implemented in the US. So multilateral wells. We have the better frac technology has not been implemented yet. We see the longer horizontals in heavy oil. We see some of the CO2 and polymer floods still in its very early stage in conventional oil in Canada. And then you have the base bonus of the exchange rate. You have a 30 to 35% bonus on the price of oil. If the price of oil is $90 a barrel, you are getting between $120 and $125 a barrel Canadian. So just at the base of everything, you're getting this multiplier bonus on there. On top of that, you have certain small to mid cap names with up to 3 to 4 years of tax pool coverage. So they're not paying any cash taxes on the entity for the next 3 to 4 years. So it's a win after win after win after win. The companies are very attractive acquisition targets. The companies have their own internal growth levers. They have their own enhanced oil recovery levers. And once again, they trade at 85 WTI, let's say strip. They trade at sub 3 times cash flow. And some of them are paying 6, 7, 8% dividends. Some of them are buying back stock on top of that. Some of them have some leverage on it if you wish to accelerate your returns or if you wish to take on that leverage. It's a very minimal leverage. You'll see billion-dollar companies with 300 million of leverage. So absolutely manageable. It's usually term debt that's termed out multiple years. So no quite like near term, this company is going to go bankrupt risk because the debt is not due till 2027 or 2028. And again, if you think oil prices are not going to be higher until then, you shouldn't be in the sector. So once again, make that point. So that's what the traditional average investor coming into the sector with some knowledge of oil should be looking at. If you are a more detailed investor, you are a value hunter, you are really looking to overjuice your returns in the sector. The junior oil company space within Canada is very attractive for a couple of reasons on top of the small to mid caps. The one being is they trade at even cheaper cash flows multiples. So in some cases, sub 2x multiples where they're at. So in my opinion, if you believe in a bull cycle, your downside risk at 2 times cash flow is much lower than people perceive it to be. These junior companies also have very little debt. So compared to the oil and gas junior companies of the past, which were loaded up with debt, like 3-to-1 debt to equity, 4-to-1 debt to equity, we just don't have that anymore. We're seeing very, very manageable debt levels. In some cases, they run with no debt, which I've got my own thoughts on that sort of business model, but I'll leave them for now going forward. So where is the risk? Where is the bankruptcy risk? And then the third thing is they have the production growth capacity to where it matters. So if you got a 20,000 barrel per day company, small to mid cap, how much are you going to increase production? 10%, 20, 30, 40%? If you're a company making 700 barrels per day, you can 4x production from your same field just by drilling some horizontal wells, doing a bit of water flooding, acquiring a couple of pools, maybe doing a polymer flood, and well, bam, you have 4x production, you have 5x production, you have 5 extra cash flow. And if you grow production into this rising commodity price environment, you can see how it supercharges the return profile on that. Once again, you have to believe in higher prices for this to work. There is a graveyard of companies over the last 10 years that believed in $80+ oil and they didn't get $80+ oil. So they got buried. Well, now the cycle is at a different point than it was back then. So understand the macro, understand what makes this cycle different. And people keep saying it's never different. Well, I'm telling you, it is different. Every cycle has always been different. There's always been factors that are unique. We've never had a entity that has taken up 70% of the growth over the last 7 years and declines at a 50% rate year over year. Never. We've never had that sort of production growth phase at the margins. So to wrap all that up that's where I see opportunity. Specific names wise, I will let you look at the White Tundra website if you want to, whitetundra.ca. My portfolio is completely public, updated as of August 31st. So there's about 50% of the portfolio is small to mid caps that I mentioned. I have them on leverage, so I buy them on margin, and then I have about 50% of the portfolio in the junior side of the game, including some with very, very nice warrant coverage as well, which is the opportunities that are presenting themselves to White Tundra. People come and say, hey, we can't raise this amount of money. Can you help us? Well, if you want me to raise that, and if you want me to invest in this, I'm going to do the full DD. We do the full DD, the full due diligence. We talk to management, we talk to field operators, and then we say, okay, we're going to want shares at this price with this sort of warrant coverage, and we make a deal happen. If they don't want it, great, we'll just walk away and we'll wait, because people are not willing to invest in these junior oil companies and support them. So the opportunities in these names are still where they are, despite the fact that WTI has run up last year, despite the fact that now we have run up again this year. They still trade at sub 2 times cash flow. And the re-rating is not going to happen overnight. But if I can bet on the re-rating plus production growth and cash flow growth, it just puts me in a better spot to take advantage of the cycle. So that's where I'm looking at. People want to look at oil field services. People want to look at blue chips. People want to look at some of the refiners and the pipeline companies. You can look at their performance now. Some of them have done exceptionally well. Some of them have done very poorly. And the real question is, how are they going to do in the next couple of years? And I would argue that people are not going to be happy with the returns on blue chip companies, on refiners. Well, I'll leave refiners out. Blue chip companies and the midstream companies that are quote unquote safe, the returns on them are just not going to be there to be in this sector. Like this is my extremely, extremely strong view opinion. Those companies are going to make you no money as a shareholder. And especially on a relative basis, it's just not worth the risk of being in this sector. Any blue chip company, even in the oil sector, has inherent risk, commodity price risk that you're taking on, which is different than other sectors with individualized companies that are doing their own thing.
Is there anything that you'd like to share that you think I've missed?
No, I think this is really where we are. I said this on yesterday's. We had a big Twitter space yesterday. I think there's 2 points that are very, very important. One is that if you want to make money in this oil industry, if you're going to be here for the structural cycle, do not fall in love with your names. Do not fall in love with a specific management team or a specific company or a specific asset. If that asset outperforms to the point where that company's valuation is well above its peers, I think, and again, I can't give you any investment advice. I think the prudent move is to swap. If you know a different company that's got similar assets, similar profile, and yet is trading at half the valuation, that valuation in a bull cycle will likely normalize to some extent or another. It may not go 1-to-1 because this company has a better management or they have a better growth opportunities, whatever. But look for valuation mismatches like that. I can tell you right now, those valuation mismatches exist today because of the move in the price of oil, and yet some names just haven't moved the same way at all relative to how their peers have moved. So do not be afraid to swap out names when you're done with them. I would say don't just swap into names that you have no idea about. So still work on understanding the company, work on understanding why there's a valuation mismatch, try to understand what the differences are, what the similarities are, what the market is looking for, where the funds flows are going. Are there any big funds exiting a certain name, which is why the stock has been depressed? Try to understand those factors, but do not fall in love with any name in this structural bull market. Some people will find this ironic because I myself have had names that have been in my portfolio for 18 months or 2 years. But the reality is they just haven't been able to get to the points where I think that the valuation on them is juicy. They made a lot of money, but they still trade at relative discounts to their peers, or they have something about them that makes them particularly special to run for this next part of the bull cycle. So that's the first point. The second point is don't be afraid to be positive. So there's a lot of oil bulls that get targeted day in, day out with people saying, oh, you were wrong in 2022, you were this, you were that. And I'll just tell you the hard, cold truth. We made more than 1,000% in a lot of cases from the COVID lows till 2022. And we made exceptional gains in the last 3 months. So we're in this market to hit home runs. We're in this market to hit grand slams. And there's a few pitches you just have to let go. There's a few fans that are telling you, hey, swing, that you just have to tune them out, let them speak their nonsense, and you go and you swing at the pitch that is the pitch right in your wheelhouse, and you slam that thing 400 feet. So I think there's a lot of negativity in the sector. There's a lot of oil bulls that are constantly trying to hedge themselves and say, oh, well, I think this could happen, or China could do this or do that. And it's good to be vigilant. It's good to be cognizant that there are risks in this sector, but don't let this gray oil bear cloud just rain on you the entire time while you're being showered in cash from the markets. Learn to enjoy those. Learn to take your profits and spend them a little bit too. Maybe spend some on gasoline as well. Help our own case. And yeah, just enjoy the ride. Like this is not going to be an easy market. This is not going to be something where you just get millions of dollars overnight. But at the end of the day, anybody who's made these sorts of returns in oil markets will tell you that it was way more than worth it. When you can make 50, 60, 100x over the course of a cycle, there's no other thing that matches that sort of return profile. So yeah, that's the one thing. I've been getting this a lot in the last month or so. So I really want to make this point where a lot of people are scared. A lot of people are saying, well, we hit this, but are we going to collapse again? Are we going to see demand destruction? Are we going to see recession? And it's fine to look at those things, but don't put too much emphasis on things that we don't have the data for, or that we can't properly predict, or that we have the data for, and it's showing no sign of demand loss or recession. I think take the data as it is, look at it from a more practical manner, and we will enjoy our ride up a lot more going at it with this view, especially when you're making money. Like when your entire screen is green, week after week after week, day after day after day. That's a good place to be. Not many people get that sort of feeling. So I'm happy to see 90. Are we going to stay here? We'll find out. But we're already sitting on some exceptional gains, and even the last 3 months have been very, very worth it. With obviously upside to go, as I believe some of the equities have not re-rated yet to the same way that the oil prices moved up in the last 2 to 3 months.
Those are some good closing statements. If somebody wants to follow you, how do they follow you or reach out to you?
Yeah, so the website is whitetundra.ca. You can see my portfolio on there. You can see the upcoming events. You can see the archive seminars, and then the price target spreadsheet, which I'm still working on. I'm just very behind on that part of it right now, but it has a bunch of resources. It has my articles of the past and some other podcasts and interviews as well. And then the Twitter, where I'm most active, White Tundra SG. So if you go on White Tundra SG on Twitter, you'll find me. I like to post about supply, demand, inventories, engineering, petroleum topics, global valuations, and well results, everything to do with the oil sector going forward. And yeah, those are probably the best. I'm also on YouTube at White Tundra SG, but that's literally going to be what's on the archive seminars, and a lot of the information is on there. And yeah, always available by DM or by email as well, which is again on the website or the Twitter accordingly. So yeah, I've got some great messages in the last few months. So always happy to chat.
All right, guys, that's all I've got for today. Thank you for coming on, Shubham. Appreciate it.
Yeah, thanks for having me.